two types of we have two types of free cash flow. This is abbreviated as FCF. We have two types of free cash flow. One, we do have what we refer to as the free cash flow, free cash flow to the firm, free cash flow to the firm, and this is abbreviated as FCFF. So when talk about the free cash flow to the firm, this is defined to be the amount of cash which is available to all the providers of capital, who include the shareholders and also who refer to the providers of the debt capital. Basically, after now, the company has paid both operating and the capital what expenditure. So therefore, you say that this is the cash available, available to all providers, of capital, who include now the ordinary shareholders, this will also include debenture holders, etc. After payment of operating, and capital expenditure. And for us now to be able to compute this particular amount of cash which is available after the company has paid both operating and capital expenditure, and which now will be available to all the providers of capital, there are various formulas which we use to compute now the free cash flow to the firm. The formulas which we use in terms of computing fees, that is the free cash flow to the firm. Number one, we can use this formula whereby we take NI. NI is the net income. In other terms, that is what we refer to as the profit after tax. To that we add the NCC. When talk about NCC here, we are talking of the non-cash items. Hope you can be able to remember what we said in our first class when we were looking on the introduction to cash flow. We see that the non-cash items basically refers to those particular items which do not entail movement of cash, e.g. depreciation, amortization, gain or loss on what? On disposal. That's now what refers the non-cash items. To this then we add the interest, but that interest we get it net of tax, meaning that we multiply that with 1 minus tax rate, and then to this we less two items. One, we less something known as FC. FC is the capital expenditure, and then still we less WC. WC is a working capital expenditure. So that is the first approach we can use to compute that. And two, we can also compute the free cash flow to the firm by using what we refer as a EBIT. EBIT is what we refer as earnings before interest and tax, or basically the profit before interest and tax. And then we also need to multiply that with 1 minus a tax rate. To this we also add depreciation, and after adding depreciation equally, we also less two items, the capital expenditure and working capital expenditure. The other formula which is also used in terms of computing and the free cash flow to the firm is whereby we take CFO. Remember, CFO here is the cash flow from operation, and then to this we add the interest. We multiply that with 1 minus tax rate, and then to this we less the capital expenditure. Still, we also have the other issue, the other formula, that is whereby we take change in cash balance, and then to this we add net net debt payment, plus net payment to stockholders, holders. Basically, when I talk about the net payment to the stockholders, this is usually given by the amount of dividends which has been paid, plus what refers the stock repurchase, or basically a share repurchase. When we talk about share repurchase, that is basically the amount of money spent by the company in terms of buying shares back, and then we less any amount of money which has been raised from the issue of the shares, meaning that to compute now this, that is the net payment to stockholders, So we take cash dividends paid, plus share repurchase. This is the amount of money spent by the company in terms of buying shares back, and then we less share issuance. This is basically the amount of money raised by the company from the issue of shares. On the other hand, when we talk about now the net debt payment, this basically refers now to the amount of money which is paid by the company to debt holders, and this is given by the interest, but we take that interest net of tax, plus what refers a debt repayment, any amount of money spent in terms of repaying debt, plus debt issuance. When talk about debt issuance, we are talking of the amount of money raised by the company from issuing the various debt instruments. So that is basically the various formulas now which we use in terms of computing now our free cash flow to the firm. Now, the other type of the free cash flow to the firm which we have, number 2, is what refers the free cash flow to equity. Free cash flow to equity. This is abbreviated as FCFE. When talk about the free cash flow to equity, this refers now to the amount of cash which is now available to the providers of equity capital only, after the company has now paid the operating expenses and also the capital expenditure. So therefore we say that this is the cash available. This is the cash available to providers of equity or ordinary share capital, after payment of all operating expenses, and that is operating and capital expenditures, expenditures. Now, this particular free cash flow to equity, still it can be computed using various formulas. Free cash flow to equity. This can be computed using the first various formulas. The first formula which can be used in terms of computing this is net income, which I have said is a profit after tax, and then to this we add the non-cash items, e.g. depreciation, amortization, and so on, and then to this we less working capital expenditure, and then still we less capital expenditure, and then to that we add net borrowing. Remember, we have looked on how we compute the net borrowing. Basically, net borrowing will be given by this. Basically, what refers is the amount of money spent in paying debts plus less any amount of money raised in terms of issuing debt. Then from there we also have the other formula, which is CFO, free cash flow, that is cash flow from operation, and then to this we less what we refer as a capital expenditure plus net borrowing. And then finally the other formula is whereby we take change in cash balance plus net payment to stockholders. In our case, we have said that this is another name for ordinary shareholders. So therefore we do have those as basically the various formulas which use in terms of computing now the free cash flow to equity